When we look at the stock market, we first have to address which one. US markets, emerging markets, Europe, each one behaves differently. Each one has its own set of problems and positive notes. Most people believe that their investments are somehow sheltered from the other markets, but this is truly unwise. Contagion spreads faster than you can imagine. You came here for the truth, so let me unveil that for you. Today we're going to look at the stock market, and what is this claim? The market's going to crash in December of 2018? Have I finally made a timeline for the stock market crash to collapse everyone has been waiting for? No. It is Morgan Stanley, which is predicting that the market will see its top in December of 2018 and will head down from there. I'm not suggesting this because I have a difference of opinion. As long as they're willing to print money, these markets can continue to go higher. A lot of people will ignore what's going on in other countries. Not just look at the Fed. We need to understand what's going on in all these other countries. They're still printing. They're still printing a lot of money. That's changing now. But if you look at this red line, basically, Morgan Stanley Research provides these reports occasionally, and this shows us that we can definitely see where they think it's going to go. I want to look at some of the details today and begin really with this. Global liquidity, broad money supply. You can see the central bank quantitative tightening on the right-hand side here, and it's important to be able to look at this, to be able to know what's going on with the year-over-year growth in central bank quantitative easing. It's important to always understand the money supply because this is everything. If they're willing to print money and they're willing to put that into bonds and ETFs and stocks and mortgage-backed securities and so on, that gives the market confidence that there is an insurance policy, that in the event something bad happens, hey, we'll be there to backstop the losses. That's why the market has gone up. It doesn't mean that there's people who always deny this, suggesting, well, the central bank only printed this much money and look at the total amount of money in the stock market, therefore it's just a drop in the bucket. But you're really, you know what? Let me just move on. Look at these facts. You can see the central banks around the world have printed more money than you can understand. When you look at the Federal Reserve, they had $4.5 trillion on their balance sheet. With $4.5 trillion, doesn't really seem like that much these days, even though it is. Well, look a little closer, and you find the limited audit of the Federal Reserve. It found them to have actually printed $16 trillion that was not accounted for, not on their balance sheet. So in fact, they printed over $20 trillion. That was given out to institutions all around the world, and we are still, to this day, unsure if the Fed ever got their money back. I have to think probably not. The Federal Reserve somehow, for some reason, bailed out banks in Canada. That was never discussed, and in fact, the finance minister in Canada at the time said this is not true. We never got a bailout, and they lied to the public. Still to this day haven't admitted it. Once the quantitative easing train stops, we're going to have a problem. Now, surely they could reverse the trend. They could stop. They could slow down on their interest rate hikes, and they can print more money. And then the markets probably will go higher. I'm not denying that. I actually think that the market will go higher as long as there's quantitative easing in the system. It doesn't have to come from the Federal Reserve. It's the Swiss National Bank. It's the Bank of Norway. It's the Bank of Japan, the People's Bank of China, and they're all doing it. The money sloshes around, and it could end up in US tech stocks. It could end up in real estate in Singapore. It could end up in real estate in Hong Kong or Vancouver, Toronto, and so on. We don't know. Once it's released, it's kind of has a mind of its own. But it doesn't end up into the hands of the middle class. That's for sure. I can determine that right now. So when you look at something like this, understand that this is the most important factor. Where's the money printed? Where is it going? And what's going on with interest rates? Right now, we are seeing interest rates climbing super slow, but they are. They claim that in this year, 2018, we're supposedly going to see two increases on the rates. I would love to see that personally. I think it would be great to try and get towards, very slowly, try and get towards this new normal, I guess you could say, with trillions of dollars on the balance sheet, and try to maintain somehow, increasing interest rates. I don't think they're going to be able to do it, but maybe, who knows. This is out of market watch, and basically it's in with one individual from the IMF and another individual is a Fed president, and they're talking, so it's quoting them. I'll just mention a couple points from it here. This is actually one of the most amazing things I've seen in a while. In his speech at the Fed conference, Blanchard said that the size of the balance sheet is not a constraint. Yes, they are scary, but that doesn't mean it cannot be done. If we need it, we could clearly double it and nothing terrible would happen. We could double our balance sheet and nothing would happen. We could double the amount of money that we print and nothing would happen. They've already printed $4.5 trillion that they admit. They've already printed $20 trillion $20 trillion since 2000, $15 trillion globally since 2008. So all the central banks, all the major central banks together printed $15 trillion admittedly on their balance sheets just since the financial crisis. And then you look at the secret bailout that occurred, the $16 trillion, add that on top of all the rest, we've got a big pile of money. So they're suggesting that they can double it. I don't know what exactly they're referring to. Are they referring to the 4.5 trillion, the 20 trillion, the 15 trillion, whatever. Doesn't really matter. It's a lot of money, and you can't take it back. At the moment, the Fed can only buy treasuries and mortgage-related assets. I believe that will change actually in the next crisis. The best policy would be for the Fed to buy assets with high premiums, like stocks, he said. This could do the trick and could work even better than buying long bonds. Well, obviously, if things got really bad, monetary financing of the deficit is something that could work to increase the demand. Can you believe that? He said, in here, you could just read it for yourself if you're interested. He said, financing the deficit, okay? So monetizing their garbage debt. They could do that. They could buy stocks. They could do that. They could double their balance sheet. They could do that. And they could do all of this. But what's it going to do to the dollar? What's it going to do to the average person? Not the fake dollar that you see, USD versus the euro and USD versus this currency and that currency. How's it doing? Look, these are all manipulated to their advantage. I'm looking at this for what it really is, and I see individuals and their paycheck. I see individuals and their expenses, and that's what it comes down to. Today, we have ever-increasing expenses, and we can thank the Federal Reserve for that. You don't have to necessarily yell at your produce department and yell and scream and asking them, why is this more expensive than it was last year? This is what they do. They devalue the currency and make everything more expensive. Okay, the S&P 500 and corporate earnings, we are seeing this today becoming another issue because in the black line, so the blue line is the S&P 500 and the black line is corporate earnings. And they're saying basically once it gets to a peak, we generally have a market which falls here, and you could just see how we're kind of there. I mean, 2015, you remember what happened in 2015. This started to dip. So the Fed, all their stimulus programs finished. They held on to their $4.5 trillion of assets, but things started to look ugly. So the other central banks around the world came in to fill in the pieces, fill in the blanks, but it's definitely leveled off here in terms of corporate earnings. I'm going to tell you that right now. Where it's going, I'm not sure. Fang Stocks, so this is from yesterday's trading session, but if we include the 11th, actually it has come up Okay, but it's still down over the last little while. It's surprising to me, and in fact, I would think that the Fang stocks just keep going up every single day, because why not, right? Print money and just push them up. It's great. So just wanted to give you an update on that because I do cover this very regularly. It's not often you see the Fang stocks declining, so just wanted to bring that to you. And by the way, Apple is having their conference, which will be on the 12th of September, perhaps when you're watching this, or maybe the next day. This here is going to be, I think, so they're already shorting Apple, by the way. There's massive amounts of shorts on Apple. I think it's going to actually improve the price. Usually does. Maybe not necessarily the first day or what have you, but it usually does improve it if they feel it's going to be good. And then when the sales come out, they're usually a lineup and so on. So that does push the price higher. I'm surprised there's a lot of individuals shorting it. It's surprising to me. Emerging market vulnerability this year has coincided with the sharp deceleration in central bank balance sheet growth. That's not really something that people should be surprised about, okay? Because you heard multiple central banks come out and tell the Federal Reserve, please do not stop printing money, you're going to screw us over. Well, we're hearing it, we're feeling it, that's for sure. Ray Dalio, you may know him, billionaire investor, massive, like his let's say, what he does is basically very important, okay, in the whole financial world, if you haven't seen it before. He talks about, in this recent interview with CNBC, that people need to understand his principles. That's what he's sort of famous for. And he's suggesting what's coming is going to be worse than 2008. And he made some comments here that I thought would be interesting for you to hear. I think it will be more severe in terms of the social, political problems, and I think it will be more difficult to handle. It won't be the same in terms of the big bang debt crisis. It will be slower growing, more constricting sort of debt crisis that I think will have bigger social implications and bigger international implications, all right? So you don't have to believe anything about Ray Dalio and what he does, but I do agree with what he's saying here, that it's a really big mess. It's not going to be all in this one big event and it's just going to happen tomorrow. I think it's going to be an asynchronous, rotting decline. The Congressional Budget Office, the CBO, found the budget deficit was $895 billion for the first 11 months of the fiscal 2018. $895 billion. Unbelievable. And they're actually suggesting that it will be $1 trillion soon enough. This is directly from the CBO's website, by the way. Okay? Wonderful. And copper, as I mentioned to you before, is one of the leading indicators of a crisis. And here somebody drops over 121 million pounds in 3 minutes. So this actually brought the price down quite a bit. I'm watching copper. I'm keeping an eye on it, and I will definitely bring those to you. Just wanted to show you that. It's definitely some news that I think is important. All right, now very quickly, I'll finish off the video with this. All we can say with some degree of certainty is that the next crash will probably germinate in a different corner of the financial ecosystem before spreading. Familiar warning signs may flash, but what triggers one crisis may not trigger another. This article is out of Reuters, and they made some good points in here, definitely. If you want to sort of go through all the different possible events and where this thing could come from, read this article, okay? So I'll have the link in the description under sources. Financial crashes usually result from one or more of the following: high debt and leverage across household or corporate sectors, increased risk-taking, excessive investor complacency, greed, and exuberance fueled by low volatility, rising interest rates, or lower corporate profits. There are signs to varying degrees these conditions are in place today. We got debt higher than the financial crisis. Debt going from 169 today, it was at 97 trillion, 169 trillion that was, and 97 trillion back in 2007. So over basically a decade, you're adding a considerable amount of debt to the system. And Many people feel that it's okay, don't worry, that that's not going to hurt anybody, but it will. I assure you, look at what's happening with Argentina. Look at what it did to Greece. Look around the world and you can see what debt really does do. Okay, it's talking about the leverage in the system and so on, and all the speculation that is going on today. There's a lot in here. I can't read it all to you, but definitely if you want some good info and what they think may occur, I would check this link out in Reuters. And then I'll finish it there. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps support the channel. I do appreciate that very much. And if you want the financial education you were not taught in schools, these two books have it all. You can check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.